Welcome to CoinShares, the talk, our monthly live stream to discuss everything related to crypto with James Butterfill and CoinShares research team, Chris Benningsen, Alex Schmidt, and Luke Nolan. Hi guys, how are you doing?
Well, good, thank you. Never a dull day in crypto, is there? We've been like that for another month.
The market is recovering after 4 weeks, I guess, of sell-off. A lot happened since a month ago. Let's talk about the latest sell-off. What were the main drivers, James, with the wave of liquidation, micro repricing? Was it crypto specific? What's your opinion on that?
I think it's all of those points you made. It started off with us reaching new all-time highs and quite an over-leveraged position. Classic human nature to just get over-leveraged at these kind of points. And then I suppose there was something slightly dysfunctional at the Binance exchange, and that led to what people are calling a liquidity cascade. And we could have sort of called it at that point. I mean, there were a few minor casualties, but it was actually quite interesting how few people, given how sharp the prices declined, how few people were sort of damaged by this or went past by this event. But then I think to add fuel to the fire, we had almost like a kind of macro blackout with this government shutdown, preventing the release of any sort of key macro inflation data or employment data, making it very difficult for us to judge how the Fed's going to move. Obviously, they cut in October, which should have helped actually crypto assets, cutting interest rates. But in the midst of all of that, we're midway through another halving cycle. And actually, in my view, the halving cycle is well known. It's it's perfectly known. I can tell you within an accuracy of roughly a week when the next halving is going to be out for 100 years. So it's perfectly known by the market. And yet, I think historically, if you look, we have a sample size of 4 now, four halving cycles, or 4 halvings. What has happened historically, and many people, well, there's a group of people, we think they're very large whales, believe in that halving cycle. And obviously the thesis is that when halving occurs, so last time it was in, I think it was April, May 2024, that the prices rise after that. And then they start to fall roughly 2 years or a year and a half after that. And so we're kind of at that point now, midway through the cycle nearly, where prices start to fall, or they have at least historically. And what we've seen is substantial whale selling in the cohort of 100,000 Bitcoin holders or more. Actually, between 10,000 to 100,000, those whales have been quite happy lapping up the Bitcoin being sold to some extent by these larger whales. So that sort of storm of a macro blackout, a liquidity cascade, whale selling, I think, is what's led to this price decline. So then question becomes like, are we at the end of that?
Yeah.
And I think, maybe we are, because what's been really interesting from a macro, if we were to see any kind of price support, it wasn't coming from whales. The liquidity cascade has kind of run its course. So really what we needed to see some sort of macro clarity. And whilst we are still missing some really important data, we did see the Fed Governor John Williams articulate some quite dovish comments that there was a good rationale for a rate cut in December, and that was off the back of Powell earlier on this month talking about a rate cut in December not being a foregone conclusion. So the markets were pricing in very little probability of a rate cut, and after Williams' comments, we saw a complete flip around from roughly 20% probability of a rate cut to now 80 to 90% probability of a rate cut, just on Williams' comments, nothing else. But I think that has helped provide a floor. Since that point, since Williams' comments, we've seen that sort of real floor in Bitcoin prices, and then sort of bounce back a little bit in the 90,000 range now.
So in your opinion, we already have stabilized. Maybe Chris, it reflects on your latest article. You asked the question. It's published on CoinShares.com and the blog of the research. Are we in a bear market? So what should we read?
I think no. I don't think bear markets are going to be what they used to be, so to speak. But I also don't expect us to kind of rapidly bounce back and have any chance of retaking any substantial highs anytime soon. I think the amount of realized value, the amount of revived supply that we've seen on Bitcoin, essentially since April this year, is unprecedented. It's an enormous amount of dollar selling pressure that has been absorbed by the market. When you look at the sheer size of it, it's remarkable that we held for so long at the levels that we did. And I think in the end, it just started overpowering the buyers. And so with all the leverage that got flushed out, everything, I think it's natural that we now kind of go back to start, so to speak, again, try to find a new floor. I think it's going to take some time to hammer out a new floor. James talked about whale selling. There's been a lot of talk about this idea that Bitcoin is kind of at its post neo IPO kind of honeymoon right now, where a lot of early stakeholders sitting on enormous unrealized profits, often in the billions, now finally have the liquidity to exit, and a lot of them are taking the opportunity, especially seeing prices north of six figures, and you're sitting on billions of dollars of Bitcoin. I mean, you've held it for 15 years, I'm really happy for all of those guys, if I'm being honest. But if you think about the amount of buying demand that we need to absorb this selling pressure, it's insane amounts. And if you compare it to tech IPOs, I mean, Bitcoin is something like 40 times the size. In terms of total market cap than these types of IPOs are in the year or two after theirs. So the amounts that we're talking here are just stupendous, and it's going to take a while for us, I think, to kind of find a new footing. But all in all, I look at this as value right now. This is a great time to manage cost basis. Don't get too excited and go all in at any of these price points. We could, for all we know, we could be headed into like high 70s, who knows, and that could be where we find like the final capitulation bottom. But there's also a ton of accumulated realized losses now, more than we've ever seen before. So that does suggest some early signs of capitulation.
I went all in at 84. So I felt like this was the turning point. And also, are we at a point now where we're in this new sort of, what do they call it, sort of crypto winter? And I don't think so. At the start of 2022, I think it was right to see that we saw sharp price declines. And in the crypto winter, well, then it was, the Fed was acting completely differently to the way they are today. They were in the start of a very almost record aggressive rate hiking cycle. They're not there now. So I don't think we have that sort of weaker or sort of very hawkish Fed backdrop to push prices lower. So it really does come down to the question that sort of Chris made is, when we'll probably see supportive macro backdrop, but when will the whales finish selling? Chris, what do you think? What's your judgment on when the whales will finish selling?
I don't know, man. I really don't. It's always really hard to say how much Bitcoin is for sale at the current prevailing prices. If you look at realized value right now, there doesn't seem to be any sign of revived supply like slowing down. In fact, it seems to be still growing. So until we see, in my opinion, like a clear dramatic pullback in the amount of coins that are revived and brought back to market, I don't think we should expect this like selling pressure to abate.
but we mentioned whales selling to explain like Bitcoin price action. But how do you explain then if price action, which has shown like great weaknesses, and Tom Lee is sitting on 1 billion loss right now with his treasury company. How do you explain that? Because we haven't seen the same trends for ETH. Luke, maybe?
Sorry, I'm not quite sure I understood the end of that question.
Because whales sold Bitcoin, it's a fact, but we haven't seen the same behavior from ETH whales. And so how do you explain ETH price action?
Yeah, good question. Yeah, when you look at the on-chain metrics, you're right. I mean, large whales have actually been accumulating, including the DATs, etc. I think for ETH, what typically is a double-edged sword is Ethereum, is the home of DeFi, which is great. It leads that market by a large margin. But then when we have events like October 10th, the DeFi double-edged sword comes into play, which is you get this sort of mechanical selling that then ripples into DeFi, ripples into contagion. So X Vault was holding X stablecoin that was now debanked and unpegged, and some other vault had exposure to that vault, and you all of a sudden get 4 sellers in the hundreds of millions, which are not selling in a sophisticated way. They're selling to cover somewhere else, and so you get this kind of ripple effect from contagion. So I think a lot of the ETH selling has been indiscriminate from entities that have just been forced sellers for the last few weeks. ETH is inherently more volatile than Bitcoin. Not to mention, I'm sure some of the telegraphed buys from the digital asset treasury companies, given a lot of ETH buyers have been underwater for, since 2021, saw that as an opportunity to say, well, here comes all the volume from these digital asset treasury companies. So I'm sure that there were maybe not whales. I don't know what the term is for something just below a whale. But that cohort is likely selling into the digital asset treasury companies. But overall, I think it was more mechanical than anything for ETH to suffer more. It's just the double-edged part of DeFi.
Oh yeah, do you know those DeFi vaults you were talking about? They were sort of really suffering from exceptionally high borrow rates. Borrow rates spiked up to 29-30%, and that caused because a lot of these vaults are kind of driven by bots, it's automatic deleveraging. So the deleveraging in certain instances was huge. But I think it was interesting to react through the whole of this, and it demonstrates the kind of resilience of ETH. If you look at TVL, total value locked on DeFi Llama, it peaked at 90 billion. It's down to sort of 64 billion in dollar terms now. So quite a significant fall off in total value locked. But that's actually all down to the value of ETH. If you look at TVL in ETH terms, it's risen over the same time period from 20 million ETH to 23 million ETH. So it just goes to show actually the resilience. I mean, this pricing in dollars, it looks worrying. Pricing in ETH, it looks like a complete different scenario. Like people are adding ETH actually to DeFi. So I think it does suggest a lot of people are actually seeing this as an opportunity in the DeFi space. And borrow rates were exceptionally high. The deleveraging didn't help in that respect. It's normalizing a lot more now, and vaults are getting back to their sort of normal sort of offerings, yielding quite high yielding type products.
And just one last one last comment I'd add to that. When you look at the money spot liquidity on exchanges pre-October 10th, so we're talking the main ones, BitGet, Binance, Bybit, OKX. For Bitcoin, it was around $1 million. Then when we look today, it's around 500,000. For ETH, the picture is a little bit more stark. Liquidity was around 550,000 at the money on these exchanges. Now we're looking closer to 200,000. So I think, when you're trading on thinner order books, noticeably thinner, and you get these downside volatility events, it's going to affect assets with thinner order books even more. And I think we've seen a little bit of that as well. But I think James put the DeFi situation well.
Are we seeing signs of capitulations on the perps futures market as well, in terms of open interest, in terms of liquidation, or do you still think we are a bit over leveraged right now?
I mean, funding rates just went negative.
Yeah, for funding rates, like Chris said, they were negative for a couple of days, and typically on like medium timeframes, that's tends to be at least a short-term reversal, which is kind of what we've seen. Now funding rates for Bitcoin ETH are on average like 2-3% annualized, which is really nothing crazy. I mean, we've seen it as high as 30-40%. So from that perspective, it doesn't seem like people are just jumping in again on leverage. Open interest is back to levels we've seen in sort of June, previously April. So there's been a noticeable decline there. Even more so, obviously, October 10th, we saw that massive drop in open interest. We've sort of still been dropping. So it's not to say that we've been completely reset, but again, it's not like we've seen sort of the quote unquote degen activity come back in full swing yet, which is probably, I think, more healthy if we want to find a longer term bottom. We really don't want to see that jump back in of leverage, which will probably lead to another flush out.
It'll be interesting to see now, though, when funding rates go negative, they're often followed by outflows of spot ETFs, as a lot of these larger trading desks start to unwind basis trading positions. So this could lead to further kind of weakness in the spot market for a little while, which again, we need that. I
think we've already seen that. We've seen at one point we saw $5 billion worth of outflows. The basis trade was very much off the table, and in fact, you were seeing people go long futures ETFs on Bitcoin and Ethereum, which suggests they were flipping that trade around. Long the futures, short the spot, I think might have been. I think that may have played out a little bit. Certainly on CME data, it suggests that might have already occurred. But it certainly, I don't think it's that attractive again yet for people to pile back into the basis trade.
Yeah, I mean, obviously it depends on the maturity profiles and where exactly the trades are deployed. But again, I just think we need some time here. I'm not expecting some like rapid rebound out of this.
Time to hide your wallets, guys. We're going private. I'm sure you saw the whole Zcash campaign going on, especially on Twitter, for the past weeks. So yeah, there was a lot of coordinated action around Zcash, one of the oldest privacy coins right now, and I can't explain that actually. I hope you guys can do a better job than me. How do you explain this Zcash return?
I know Chris has some strong opinions as well. I'll give some initial thoughts.
No, Luke, go. I don't have much to say about this, to be honest.
So, I think first of all, if we're talking about like an actual privacy coin, then probably Zcash is not the kind of the appropriate one. I think there's a reason why when we talk about malicious actors who truly need private transactions, they don't use Zcash.
Yeah,
they use Monero, which is inherently private, default private, while Zcash you have to shield, and there's all this conspiratorial talk of who might be running nodes, etc. But I think it started off with an asset that had, first of all, it's a Dino coin, right? It's been around since forever, and it was kind of at a low base. It didn't need much steam to kind of get off the ground in a moment where a lot of kind of altcoins were already at elevated levels, and you had some influential figures on X, Mert, etc., pushing this kind of privacy narrative. What was funny and very interesting is, I think a lot of people were buying Zcash were buying it for a trade, myself included, not because I'm fulfilling some privacy narrative, but it actually turned out to be a really good hedge during the downturn. So when Bitcoin and other coins were really suffering, Zcash was actually very much positive. So I think a lot of people viewed it again as a hedge, which was further entrenching this kind of positive move on Zcash. Ultimately, I don't think it's some sort of paradigm shift to privacy. I mean, there's much more suitable privacy coins, like we've mentioned, as well as also privacy protocols on ETH, ZK rollups, etc. So, I'll leave to Chris if he wants to add anything to that.
Look, you trade more than I do, but on the exchanges I looked at, it's quite hard to trade Zcash.
Yeah,
So,
I only traded perpetuals. I didn't trade
Okay.
spot. Yeah,
yeah.
that was the only way I could get easy access to it was on Hyperliquid. I didn't use any centralized exchanges.
But there's a way, there's a way around for spot coins. I think now there's a way through Hyperliquid as well. I think they enabled the spot Zcash. So it's still quite hard on SEX, but yeah, you can find some ways.
And I think that for that reason, then its upside is potentially limited because its accessibility is quite low.
Yeah, but I mean, I guess you could make the argument both ways, right? Because the accessibility is quite low, you end up with a lot of aligned holders, right? Who are like all want to push this narrative, which I think, interestingly, that you brought up that point, which reminds me, I think the reason why it acted so well as a hedge was because of what you mentioned, James, the accessibility, right? In a downturn, everything that's like trading on the same places just goes in tandem because people sell in the same places. But like you mentioned, the accessibility for Zcash was so low. You had a group of people who just wanted to fulfill the narrative. So it worked as a really good hedge for that reason.
Dangerous to trade. Yeah, it's dangerous in that sort of scenario to trade.
Yeah, definitely.
Chris, you can't escape that. I want to hear you about Zcash.
I don't have any strong opinions about Zcash, to be honest. I'm not a Zcash user.
No, but you have one, I guess, about the coordinated campaign surrounding Zcash.
Yeah, well, I mean, it does seem quite coordinated, doesn't it? That just never inspires confidence, in my opinion. It just sounds like people are fishing for exit liquidity. You know, I think one of the questions you wanted to ask later is like, are there regulatory risks lurking here? And I think one of the reasons why Bitcoin and ETH have been acceptable to the establishment, so to speak, is that their privacy capabilities are not kind of in your face. We're almost like Trojan horsing future capabilities in by making it seem like, and it is radically transparent in a lot of ways. It's just that it has built-in functions that can be expanded upon to create quite private subparts and subsystems, even if the blockchain itself isn't in itself very private, right? And you know, we've seen that on ETH with Tornado Cash and you know the various implementations of ZK, all sorts of stuff. In Bitcoin, you can use Lightning, and Lightning is quite incredibly private, so private that we have no idea what's going on there. We can't even analyze it. And so, in my opinion, privacy is extremely important. But it's one of those things that I've always tried to be very careful about drumming too hard on about, because I just don't want the powers that be to become hyperfixated on this stuff and see it as a threat until we are entrenched enough that we can kind of, you know, bring it out from the back pocket, so to speak.
Yeah, I think it's worth mentioning as well that during the Zcash bounce, both developers of Samurai Wallet have been sentenced to 5 and 4 years of jail. So yeah, privacy is not really accepted. Let's move on if you want, guys. And let's talk about treasury companies. There's a lot of Bitcoin treasury companies, and even if treasury companies are trading below mNAV right now. Maybe for you, Alex, is it related to the current market skepticism on funding? Is it about the dilution risk? How do you explain the current situation?
Yeah, also, I would like to flag that a lot of these companies are also trading below their cost base.
Yeah.
Which is, I think, panicking a lot of people because I think there's this conception that, you know, if it trades below cost base, or if it goes down too much, you're going to have to sell to cover whatever, which is not really true for most companies. But I think, you know, there's been a rotation, you know, since summer into September, October, out of treasury companies into the miners, because obviously all these deals that were being announced with AI HPC hyperscalers, and this has led to quite a big flow of capital out of these companies. Now, with them trading below mNAV, what happens is they are not as able to fund their Bitcoin purchases. Even MicroStrategy was slowing down their purchases in October, November. I think they made a big purchase earlier this month now, but before that, they were buying hundreds only of Bitcoin every week. Before it was in the thousands. So and that's because obviously the financing situation is not as conducive to execute these strategies. Now, what can happen is, these mNAVs below 1 could be an opportunity for investors, because finally this actually makes sense to buy, because in theory you're getting more Bitcoin per share than you would be, if the premium were 100% or mNAV of 2-3x. And by the way, I don't think that's gonna happen again very soon. And one more thing to mention is that it is likely that the more leveraged names, and not a lot of them are, to be honest, but the ones that have some leverage might be the winners on the way up now again, if this trend continues. Mainly because the capital structure allows it to the leverage component should be beneficial in this point.
Do you expect some companies starting selling? I know that some ETH companies have already started to sell their assets. Yeah.
I'll tell you what, I lived to listen to Michael Saylor on a one-on-one with us at in a conference in the US earlier this month. I lived to hear that he would consider selling Bitcoin, and I was completely shocked in that meeting. But yeah, it makes sense. He's got close to $700 million of coupons and preferred dividends to pay every year, and that money is going to have to come from somewhere. The balance sheet is quite it's heavily geared towards Bitcoin, very little cash that they keep there. There's last time in their last statements they had about $50 million in cash, which is doesn't even get them through a quarter. So they need to keep going. Obviously they have the ATMs with the preferreds, but I think Saylor is very clever about funding, and I don't think he would execute dilutive strategies that are in detriment of shareholders, because he is one of the biggest ones still. So I think fortunately to shareholders, the incentives are quite aligned over there. But yeah, raising capital, especially issuing common shares with mNAV below 1, is actually not a very clever idea, because instead of adding Bitcoin per share, it would actually be diluting, reducing Bitcoin per share. At these levels, you want to add leverage to your business, issue preferreds, but not every company is going to be able to do that. So that's a MetaPlanet, I think, issued about $500 million last month in debt. So that's interesting. But obviously issuing debt also brings these questions over how much or when selling Bitcoin will happen. But by the way, MicroStrategy did sell a tiny bit of Bitcoin, 3 years ago?
Yeah, in the early days.
Yeah.
But I would like to go back to this. Yeah,
I was just going to say, the question then becomes, does it create a death spiral for Bitcoin?
That was my question.
Yeah. I mean, I'm skeptical that it would. I think Bitcoin market is trading between $10 to $20 billion a day, and if anything's told us, this most recent whale selling has been substantial, and obviously it's had downwards pressure on price, but it's not led to a death spiral. And I don't think Michael Saylor selling would do that either. I mean, ultimately, he would sell in a very orderly manner. He wouldn't be selling very aggressively to make things worse. But also, I think the market can handle it now. It's liquid enough. And we saw the sales of Roger Ver, or theoretically the sales of Roger Ver, selling quite substantial amounts, and the market's handled that with very little actual price movement. So I don't believe it would cause the death spiral that many people are worried about with Saylor selling.
All right. I would like to go back to Nova Layer 1, that is coming soon, and an announcement from Klarna, a sort of fintech enabling like loans to purchase anything, which announced a stablecoin on Tempo, a new Layer 1. Who are the likely winners and losers if Tempo, a stablecoin only Layer 1, gains tractions? Do you think that it's gonna have an impact on issuers, on banks, on smart contract platforms, on over Layer 1s? Do you guys have an opinion about this new kind of programmable blockchains specialized on stablecoins?
Yes, I mean, we've obviously been discussing stablecoins extensively for the last, few months, and I think one of the open questions was who's going to benefit the most from the proliferation of stablecoins, and I think Tempo is an example of how it's going to be multifaceted. So, in the case of Tempo, Klarna, they're going to benefit from that, obviously, right? They're kind of removing the merchant middleman that they probably pay between 1% and 3% to for every transaction. Take hold of those rails. Take hold of the cash behind it, skim a few basis points on FX, on the Treasury holdings, etc. So they go from a net cost to a net gain. When it comes to the competition, let's say with incumbent smart contract platforms such as Ethereum or Solana, it certainly kind of takes away a narrative, which in my view was always a weak one, that these institutions would fully incorporate themselves as stablecoin transfer rails on these public blockchains. I just thought that was always kind of too optimistic. So certainly they lose out on that narrative, but again, I don't think that was such a strong one. The incumbent merchant payment providers will lose out. Obviously we've seen scrambles from MasterCard and Visa to kind of make some M&A acquisitions and make some movements into the space because they've realized it's no longer worth fighting against it. You kind of have to embrace it. So I think this is where we'll see the proliferation of stablecoins for providers such as Klarna. Earlier this year we saw Amazon toy with the idea of an Amazon coin of some kind. Again, it makes sense for companies that are moving billions of dollars a day or a week to take hold of those rails, skim a few basis points. When we're talking about a few basis points on billions of dollars, it does certainly move the needle. So yeah, it takes away from some of the narrative of incumbents such as Solana, Ethereum, but not really in the way that I think most people should be frightened about. The liquidity aspect of stablecoins on smart contract platforms is very different from those of the A to B efficiency that's gained from a provider like Klarna, right?
I also just want
Chris.
to add here. I agree with Luke that, of course, in a perfect world for Ethereum, they would have this these stablecoin assets like settled on Ethereum. But what I think is important to note here is that all these new kind of stablecoin designed L1s, they're all using EVMs. Like the EVM is so entrenched now, and they're all doing it so that they can create bridging systems to have their assets be portable over to Ethereum for participation in DeFi. Because if not, then it's like you were suggesting there's a siloing and a liquidity problem happening. But if you do have effective bridging, then you can use these for the speed and the control and all of that you kind of need to be compliant with all of these new congressional acts coming out of the US. But you can still allow bridging over and access to DeFi. which hopefully then will allow you to very easily move between Klarna coin and Meta coin and Amazon coin and, you know, this, that, and the other, such that maybe in the future the user doesn't necessarily even know, or you know, they just have a wallet built into their browser and it's like, you're on Amazon, like, how would you like to pay? It's 98 Klarna coins, but it's, you know, 93 Amazon coins, you know, given like the prevailing exchange rates and the deals that are available and the markets that will then hopefully naturally and very smoothly form using like the automation that DeFi can provide. So there is the potential for actually something really cool to come out of this. And I think Ethereum is not poorly positioned at all, because it's all going to be EVM compatible. It's all that same language. So
yeah, no, that's a great point, Chris. And I think to further that point, I mean, you know, one of Ethereum's main researchers over the last few years, you know, Dankrad Feist, he's joined Tempo. So who better to understand the inner workings of the EVM and how these things can interoperate? And I think importantly, and correct me if I'm wrong, the gas token on Tempo is basically whatever you want it to be, right? So it could be USDC or, you know, Metacoin or whatever. And I think from a you know, a provider like Klarna, that's obviously super important. You don't want to be exposed to the underlying volatility of a gas token such as ETH. So it totally makes sense. Like, it's the game theory optimal move for them to make to brace the efficiencies, but as Chris mentioned, stay in the EVM world, which is, you know, certainly all the kind of new layer ones we see nowadays, they typically go for that because it is probably the most well-structured architecture around and does allow for that composability or potential composability. So yeah, that's a good point.
But when it comes to the L1 themselves, like, you know, there's a ton right now. Plasma actually as well. There's going to have Arc from Circle. And in the end, you always have to, you need to pay the sequencers, the validators. Do you think there's a business for everyone?
Probably not. I think if anything, crypto has taught us that, you know, sometimes the best tech doesn't win. I think it's really that simple. Like, if we look even 2021, the amount of new stuff, it's like, oh, this is 10 times faster than Ethereum. This is 10 times cheaper. Sometimes it really doesn't matter. It's all about network effect. And I think that there's this sort of critical mass for you to gain, for you to start benefiting from the inertia of movement. And a lot of these new L1s, unfortunately, won't have that. It remains to be seen. But again, I think it's really not the best tech that will win. It's from the let's say provider side, it's the ones that can make the most B2B deals and kind of get the wheels rolling. And then from the consumer side, it's where's the liquidity, where are the pools, where's DeFi already established. It just, once the wheel starts turning, it's hard to stop it, and vice versa. It's hard to get the wheel rolling.
The network effects, the Metcalfe's law, ultimately, I think that's such an important thing in crypto. We sometimes get a bit too lost into the great tech that something might offer, but it's unfortunately it's often not enough. The main thing is, are enough people using it? And if they are, they can be surprisingly forgiving of some deficiencies. And I think Ethereum is actually a really good example of that.
It brings us to a new layer one, actually, mNAV, which came out on Monday. Any thoughts on this launch, especially the choice of not listing with Binance? So it's layer one EVM compatible with a parallelized execution, something similar as 3, likely, in terms of technical architecture. Do you have any opinion on this layer one, and do you think it will last?
Well, so I think that kind of, you know, was a perfect segue onto that, which is it's clearly great tech. I think from a retail investor perspective, it's not such a great launch, and I say that as someone who did actually get tokens airdropped, but which is great. You know, I'm not complaining about that, but you know, it's launching at a pretty incredibly high FDV already. Sort of from a you know, let me preface this by saying, like, when there's kind of this fair launch opportunity at a low FDV and people get excited about it, and you know, they want a piece of the pie, they're more likely to use that chain. They're more likely to start building on it. but sort of when the starting line is already halfway to the finish line in terms of size, I think it dissuades some building. On the other hand, launching at such a high FTV means that the foundation, the builders do have quite a lot of money to throw around for incentives, for grants, for building programs. So it's possible. I mean, like I said, it's great tech. It's undeniably really good tech. But we've seen great tech over and over, and we've seen tech that has had maybe 15 minutes in the spotlight because they've done a bunch of incentives or partnerships with stablecoin issuers to offer outsized yields on, let's say, the main lending market. But unfortunately, when those incentives start tapering off, so does activity. You need really something to really entrench it. In Monad's defense, its extremely high performance capabilities means that if it can really get some high performance application to be a hit on there, that could be enough to get the wheels turning. I mean, I'm relatively optimistic, but also given the history of launches of this nature, you have to be a little bit cautious, I would say.
All right, let's James.
I want to do a little straw poll actually to see what people think about this. So Matt has done some very good work. Chris might know the answer to this. He's scraped data from CoinMarketCap, and he's been looking at the overall number of cryptocurrencies and how it's changed over time. So obviously when Solana came online and we had Pump.Fun and the rise of meme coins, we saw sudden spikes and things like that. How many cryptocurrencies do people think there are in the world at the moment?
I mean, is that even knowable?
Yeah.
Well, Matt,
if we're counting Pump.Fun, then I would guess
millions.
40 million.
You're high. That's like, so I would have said, maybe 15,000, and that's a number I've been saying for a while. It's 27.1 million according to Matt. So it's just incredible how many different cryptocurrencies there are, and we do get questions.
We've democratized money printing,
and most of them are on Solana. Finally, in the end.
Yeah.
So I mean, democratized money printing power to the people.
But I mean, I think that's not to get too off topic because I know we're almost out of time. But just a brief comment on what James said. I mean, I think in my view, one of the reasons why we haven't seen a broad-based kind of altcoin season is because liquidity has been so dispersed into these 10K market cap, whatever it's called, on Pump.Fun, where someone thinks they're gonna get out of the trenches, quote unquote, and that just happens repeatedly. While you look at 2021, there was maybe 100 coins to pick from, and there was weeks where it didn't matter what the coin did, it was up 100% because people were just buying everything. It's not, the game has changed significantly.
Agree,
but not the love for it.
Let's wrap it there, guys. I advise you to read Chris Slater's article on CoinShares.com. Are we in a bear market? You will forge your own opinion. And maybe, guys, we'll find some time in 2 weeks to introduce your new outlook from 2026. Maybe we could do that. I think it's worth a read. Thank you for your time, and see you quite soon on CoinShares.com. Take care, guys.
Thank you.
Take care.
Bye-bye.
Goodbye.